Hello students, welcome to the brief discussion of the topics that are going to be covered during week 6. So the last type or the last tool that I will be discussing under financial statement analysis is cash flow analysis. During day 1 and day 2, I'll be explaining you how to prepare cash flow statement according to accounting standard 3, that is indirect method, and then I will be commencing module 4, that is management accounting, and I'll be discussing about the scope, purpose of management accounting, the cost, volume and profit analysis during day 4, the methods of determination and applications, and also during day 5 managerial decisions, that is making or the buying decision. Now, what is cash flow analysis? We know that cash plays a very important role in the economic life of any business organization. Firm needs cash to make payments to its suppliers, for incurring day-to-day expenses, to pay salaries, wages, interest and dividend, etc. In fact, what blood to the human body is, cash is to a business enterprise. It is very essential for a business to maintain an adequate balance of cash. But many a times a concern operates profitably and yet it becomes very difficult to pay taxes and dividend. This may be because although huge profits have been earned, yet cash may not have been received, or even if cash has been received, it may have drained out for some other purposes. This movement of cash is vital importance for any organization. So, from the financial statements, that is balance sheet and profit and loss account, which provide the essential basic information on financial activities of a business, its usefulness is limited for analyzing and planning purposes. Balance sheet does not disclose the causes for changes in the assets and liabilities between two different points of time. The profit and loss account also fails to disclose the reasons for shortage of cash in spite of positive net income. Thus, another statement called fund flow statement will be prepared. Fund flow statement will be prepared to show the changes in the assets and liabilities from the end of one period of time to the end of another period of time. And in order to underline the importance of fund statement, the Institute of Chartered Accountants of India, with the preparation of statement of changes in financial position, has issued the accounting standard 3 that deals with fund flow statement. The statement of changes in financial position summarized for the period covered by it the changes in the financial position, including the sources from which funds were obtained by the enterprise and the specific uses to which such funds were applied. For this purpose, the term funds was defined as cash and cash equivalents or as working capital. The statements of changes in financial position, also called funds flow statement, it was intended to provide a meaningful link between the balance sheet at the beginning and at the end of a period and the profit and loss account for that period. Although the fund flow statement provided useful information, it suffered from so many limitations, and hence to overcome these limitations there was a need for cash flow statement prepared in the standard format. And the Financial Accounting Standard Board USA has emphasized the need for cash flow statement, as financial reporting should provide information to help present and potential investors and creditors and other users in assessing the amounts, timing and uncertainty of prospective cash receipts from dividends or interest and proceeds from the sales, redemption or maturity of securities or loans. The prospects for those cash receipts are affected by an enterprise's ability to generate enough cash to meet the obligations when due and its other operating needs to reinvest its operations and to pay cash dividends. The cash flow statement deals with the provision of information about the historical changes in cash and cash equivalents of an enterprise by means of a cash flow statement which affects which classified cash flows during the period from operating, investing and financing activities. So what is cash flow statement? It is a statement which describes the inflow of uh, and outflow of cash and cash equivalents in an enterprise during a specified period of time. Such a statement enumerates net effects of various business transactions on cash and its equivalents and takes into account receipts and disbursements of cash. A cash flow statement summarizes the causes of changes in cash position of a business enterprise between dates of two balance sheets. According to Accounting Standard 3, an enterprise should prepare cash flow statement and should present it for each period for which financial statements are prepared. The term cash, cash equivalents and cash flows are used in preparation of cash flow statements, where cash means cash on hand and demand deposits with banks. Cash equivalents means they are short term, highly liquid investments which are readily convertible into known amounts of cash and which are subject to an insignificant risk of changes in value. Cash equivalents are held for the purpose of meeting short term cash commitments rather than for investment or other purposes. For an investment to qualify as a cash equivalent, it must be readily convertible to a known amount of cash and be subject to an insignificant risk of change in value. So, for example, preference shares of a company acquired shortly before their specified redemption date. Cash flows are inflows and outflows of cash and cash equivalents. Flow of cash is said to have taken place when any transaction makes changes in the amount of cash and cash equivalents available before happening of the transaction. If the effect of transaction results in increase of cash and its equivalents, it is an inflow, and if it results in decrease of total cash, it is outflow. So, cash flows exclude movements between items that constitute cash or cash equivalents because these components are part of cash management of an enterprise rather than part of its operating, investing and financing activities. Management accounting, it is comprised of two words, management and accounting. What is management accounting? It is the study of managerial aspect of accounting. The emphasis of management accounting is to redesign accounting in such a way that it is helpful to the management in formulation of policy, control of execution and appreciation of the effectiveness. It is the system of accounting which helps management in carrying out its functions more efficiently and more effectively. So, there are so many definitions given by different management accountants for management accounting. And management accounting, it is the new approach to accounting. It provides techniques for the interpretation of accounting data. It helps in developing realistic approach to future course of action. Some of the facts of management accounting are of great significance and they form the scope of this subject. Financial accounting, it deals with historical data. The recorded facts about an organization are useful for planning the future course of action. Though planning is always for the future, but still it has to be based on past and present. The control aspect too is based on financial data. The performance appraisal is based on recorded facts and figures, and hence management accounting is closely related to financial accounting. Cost accounting provides various techniques for determining cost of manufacturing products or cost of providing service. It uses financial data for finding out cost of various jobs, products or processes. The systems of standard costing, marginal costing, differential costing and opportunity costing are helpful in management for planning various business activities. Financial management is concerned with the planning and controlling of financial resources of the firm. It deals with raising of funds and their effective utilization. Its main aim is to use business funds in such a way that earnings are maintained and maximized. Finance has become so much important for every business undertaking that all managerial activities are connected with it. Financial viability of various proportions influence decisions on them, and although financial management has emerged as a separate subject, management accounting includes and extends to the operation of financial management also. Management accounting is also closely related to budgeting and forecasting, inventory control, reporting to management, interpretation of data, control procedures and methods, and internal audit and tax accounting and other office services. Management account may be required to control Accountant may be required to control an office. He will be expected to deal with data processing, filing, copying, duplicating, communicating, etc. He will also be reporting about the utility of different office machines. So these are some the scope and the relationship of management accounting with other disciplines, and I will be explaining about the cost volume profit analysis, where here we will be studying about the relationship between the cost volume and profit, how the cost affects the profit and how the volume is going to affect the profit of an organization. So that is what is studied under cost volume profit analysis, and this cost volume profit analysis is the subject under marginal costing, uh, where marginal costing is the ascertainment of marginal cost and of the effect on profit of changes in volume or type of output by differentiating between fixed cost and variable cost. So actually here under marginal costing, the costs are divided into fixed cost, variable cost and semi-variable cost, and only the variable costs and semi-variable costs are taken into consideration in determining the profit. So cost volume profit analysis, it is a technique for studying the relationship between cost, volume and profit. Profit of an undertaking depends upon a large number of factors, but the most important of these factors are cost of manufacture, volume of sales, and selling prices of the products. In the words of Herman C. Heiser, the most significant single factor in profit planning of the average business is the relationship between the volume of business costs and profits. Cost volume profit relationship is of immense utility to management as it assists in profit planning, cost control, and decision making. It can be used to answer questions like how much sales should be made to avoid losses, how much should be the sales to earn desired profit, what will be the effect of change in prices, costs, and volume on profits, which product or product mix is most profitable, and should we manufacture or buy some product or component, and so on. So we also will be studying about the break even analysis. um, Actually, the study of cost volume profit analysis is often referred to as break even analysis, and they are interchangeably used by many people. Why? Because break even analysis, it is the most widely known form of cost volume profit analysis. We will also be discussing about break even analysis. So what is the break even point in terms of number of units and in terms of sales volume? So which means how many units have to be sold for break even, that is it is the point where there is no profit or no loss. Also we will be discussing about the decisions making, like make or buy decision, whether to outsource, that is whether to outsource or whether to manufacture in the company itself. Why? Because sometimes a concern has to decide whether certain product or component should be made in the factory itself or bought from outside from a firm which specializes in it. In taking such a make or buy decision, the technique of marginal costing is of immense help. While deciding to make or buy, a distinction must be made between fixed cost and variable cost, and the variable cost of manufacturing it should be compared with the price at which this component or product can be bought from outside. And it is advisable to make than to buy if the variable cost of the product or component is lower than the purchase price. But if the purchase price is lower than the marginal cost, it would be better to buy than to make itself. But this decision is based upon the assumption that fixed expenses do not increase and production facilities cannot be employed more profitably. So such not only make or buy decisions, we also will be discussing about problem of key or the limiting factor, where limiting factor is a factor which limits or restricts production or sales and thus prevents concern from making unlimited profits. I also will be discussing about selection of suitable production or sales mix. That is, when a concern manufactures more than one product, a problem often arises as to the product mix or the sales mix which will yield the maximum profits. In determining the optimum or profitable sales mix, the products which give the maximum contribution are to be retained and the production should be increased. The production of products which give comparatively lesser contribution should be reduced or dropped altogether, and the optimum sales mix is that which gives the highest contribution. So in case if there is any limiting factor, the contribution per unit of limiting factor should be considered while judging the profitability of the product. And also we will be discussing about the effect of changes in selling price on profits, and also the alternate methods of production, and also determination of optimal level of activity. So, and also whether special orders or export orders have to be accepted. All these decisions are discussed in detail along with numerical problems while discussing. So according to accounting standard 3, cash flow statement should report cash flows during the period, and it is classified by operating, investing and financial activities. The cash flows from operating activities are those cash flows arising from operating activities, which is a key indicator of the extent to which the operations of the enterprise have generated sufficient cash flows to maintain the operating capability of the enterprise, pay dividends, repay loans, and make new investments without recourse to external sources of financing. Information about the specific components of historical operating cash flow is useful in conjunction with other information in forecasting future operating cash flows. Cash flows from operating activities are primarily derived from the principal revenue producing activities of the enterprise, and therefore they generally result from the transactions and other events that enter into the determination of net profit or loss. Some of the examples of cash flows from operating activities are cash receipts from the sale of goods and rendering of services, cash receipts from royalties, fees, commissions, and other revenues, cash payments to suppliers of goods and services, cash payments to and on behalf of employees, etc. I'll be explaining you in detail while taking up cash flows. And the cash flows from investing activities, examples are cash payments to acquire fixed assets, and these payments include relating to capitalized research and development costs and self-constructed fixed assets, cash receipts from disposal of fixed assets, cash payments to acquire shares, warrants, debt instruments of other enterprises, and interests in joint ventures, etc. And cash flow from financing activities. Financing activities are activities that result in changes in the size and composition of owner's capital and borrowing of the enterprise. And there should be a separate disclosure of cash flows arising from financing activities, because it is useful in predicting claims on future cash flows by providers of funds to the enterprise. And the examples of cash flows arising from financing activities are cash proceeds from issue of shares or other similar instruments, cash proceeds from issuing debentures, loans, notes, bonds, and other short or long term borrowings, cash payments of amounts borrowed like redemption of debentures, bonds, preference shares. And we also have to consider some items during treatment of some items while preparing cash flow statement, like extraordinary items, interest and dividends, taxes on income, acquisitions and disposals of subsidiaries and other business units, foreign currency cash flows and non-cash transactions, which I will be explaining you in detail in our regular classes. And there are limitations of cash flow statement, like it is based on cash basis of accounting, and hence it ignores basic accounting concept, that is the accrual basis. And some people feel that as working capital is a wider concept of funds, a fund flow statement provides more complete picture than cash flow statement. A comparative study of cash flow statement would also give misleading results. These are some of the limitations of cash flow statement. And now I will be starting with module 4, that is marginal costing and CVP analysis. Here I will be discussing about the break-even analysis, the break-even chart, what is management accounting, why it is important, what is that is I'll be discussing about the advantages or the scope of management accounting. I'll be discussing about cost, volume, profit analysis, and so on. So coming to management accounting, uh, so as I have already told you, there are three types of accounting: financial accounting, cost accounting, and management accounting. I have explained you in detail what is cost accounting and what is financial accounting. So now I will be discussing in brief what is management accounting, what are its advantages and disadvantages, what is the scope of management accounting. So as cost accounting, no doubt it serves the